I get lots of self-employed people and business owners asking me if they need 3 years accounts to get a mortgage. Now this is a complete myth. You are able in some circumstances to get a mortgage with just 1 year's accounts. So in this video I'll be talking you through how to get a mortgage with just 1 year's accounts. Hi guys, this is Sam from Rosehill Financial Services. If this is your first time watching us, I hope you do find our content useful, and please do share with anyone who may benefit from watching this video too. So when it comes to securing a mortgage where you're self-employed with just 1 year's accounts, it's key to say that there are only a selection of lenders that will consider this. I'd always recommend speaking with a great broker early into the process to get a better understanding based on your specific circumstances. So here's some things to consider. So first of all, you'll want to make sure that you have your finances in check, as lenders will want to be making sure that you have a healthy business. So firstly, you want to make sure that you have made a profit. And to get a mortgage based on 1 year's accounts, specifically if you are a limited company owner, then you'll need to make sure that you've had a full 12 months trading history. And for limited company owners, we'll be looking at your balance sheet as well, because it's all well and good if you've got turnover and profit, but if your liabilities outweigh your assets, i.e. the amount you owe outweighs the amount that you are owed, then this can show the lender that your business could go under at any point in time. So this is where it can cause some issues if your liabilities outweigh your assets, because lenders want to make sure that your business is sustainable and stable. So what documents will you need to secure your self-employed mortgage with 1 year's accounts? Well, firstly, you're going to need your SA 302, which is otherwise known as your tax calculation. Now you can either get this from the Inland Revenue or from your accountant, and it will basically show the net profit from self-employment if you're a sole trader, or it will show your salary and dividend figures if you are a limited company director. It'll also show the amount of tax that is owed as well. And the second document you'll need is your corresponding tax year overview, which will show the amount of tax paid. Now this will match your tax calculation or your SA 302. Now if you're a limited company director, lenders are going to want to see your signed accounts as well. Now this will need to be by a qualified accountant, so you want to make sure if you are a limited company business owner that you have an accountant in place with the qualifications that are required in order to secure your mortgage. Now lenders may also want to see your projections from your accountant for the following year as well, just to make sure that your business and your income is sustainable. Now lenders are generally going to want to see your latest 3 months personal bank statements. It can be more, it can be less, depending on your circumstances. And they are also going to want to see your company bank statements as well. So we would always recommend keeping separate accounts for your business and for your personal use, as this will make things a lot easier for lenders to assess. Now, one of the main things that most lenders are going to want to see is that your previous experience aligns with your new business. Now, where this is not the case, if you've started a new business and it's completely separate from what you did in the past, then this is likely to have an impact on your mortgage application. This is because if you've started a new business in the same field that you were previously employed in, then there's a much better chance that you're gonna see success in this new business. Other than this, it will just be the general checks that come with pretty much any mortgage application. So there'll be a full affordability assessment. Lenders will be looking at your income and expenditure, any sort of committed expenditure and debts. They'll be looking at your credit file to see if there's any adverse credit, your deposit, and so on. So ultimately it comes down to preparation. I think preparation is key for anyone looking to buy a home, but particularly where you're looking to use your first year's accounts. I'd always recommend speaking with a great broker early into the process so that they can advise you on your specific circumstances. If you'd like any further information on what we've discussed today, then please don't hesitate to leave me a comment or drop me a personal message and I'll be happy to help. Now before I let you go, I must tell you that your home may be repossessed if you don't keep up repayments on your mortgage. Thanks for watching guys. I look forward to bringing you more useful content in the future, and I'll see you in the next one.